Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite is Eric Balchunas, who's a senior ETF analyst over at Bloomberg. Eric, it's great to see you. As always, thanks for joining me. MarketSite, well, happy 25th birthday to the ETF industry. And I've seen you get this question a lot on Twitter. Are ETFs destroying the capital markets? I mean, I saw someone ask it the other day on Twitter. I'm like, that's kind of blunt.
They're the financial world's #1 scapegoat for sure.
Right.
Active managers love to bring this up. Personally, I think active is better off saying, okay, I see why you're into this passive thing. Watch me outperform it. They should be more like why they're better, not, oh, this ETF's going to blow things up. Again, ETFs own about 7 or 8% of stocks, so it's still pretty small. You add passive in, you get to about 16, 17%. If you get into institutional passive, you get about 20. So we're still, even with all-in passive, liberal definition, 20%. So it is still pretty small. ETFs are like a puppy dog with sharp teeth, right? They definitely scare people, especially if you're active, but they're still small and relatively harmless in terms of systemic risk. However, there are some products out there that you as an investor could maybe buy and not know what they are. So I still think there is some individual risk with buying a leverage ETF and not knowing what it is, or an oil fund. But systemically, I don't really see them as having too much of a risk. And they've been tested. Brexit, we've had February was wild, and everything traded fine. And ultimately, I would say look at ETFs versus reality. They're not a utopia. What else can you do? You can go buy stocks and bonds yourself. Go for it. You can use a mutual fund. Go for it. Or you can use an ETF, and that's fine too. So you got to compare them in reality and say, okay, well, the ETF's the best choice for me. And normally it does win. On a level playing field, an ETF can offer up so many advantages that it's hard to resist. But it is not utopia. You have to trade them. There's the spread. There's a lot of little issues that you need to take on when you buy and sell an ETF. But I personally think that they're more a disruptive force, and that's why you see the attacks increase, because they're taking in more and more assets, and some of those assets are coming from people who don't want their assets gone.
Well, yeah, basically. But I think it's interesting because, particularly in the tech space, where to own a basket of these names is just capital. It's too capital intense for the retail investor to participate in. Or here's the conversation we were having before. I want to be part of the blockchain technology craze, but I don't know what companies belong in there or don't. So then here's potentially something you can look at, because there's so many thematic ETFs out there now.
Let me jump on that for a minute, if I could. Blockchain ETFs track these companies that are in blockchain. To me, this is one that you need to worry about a little bit, because Goldman Sachs is in there. There's a couple other companies that are really big that barely get any of their revenue from blockchain. So we would call that not a pure play. It's got a lot of stuff in there that you could call filler. As blockchain increases, maybe it will get more pure. So investors should know that you are getting some general beta when you buy that. On the flip side, the pot ETF, MJ, or the one in Canada, HMMJ, again, like you said, it's another way to play something that's like a fledgling industry. I don't want to pick one of these stocks because I don't know which one could blow up. It's a high risk. They do a good job of capturing the industry, and it's about 75% pure, directly linked to cannabis sales. So that's a good idea. And if you look at an ETF like MJ, the volatility of MJ is half that of the average stock in it. So you decrease your vol a lot by going diverse, although you forego the lottery potential of picking the one that goes up like a million%. So ETFs, in a way, are sort of like giving up the home run to ensure you don't strike out either, and hopefully you get like a base hit.
Well, I mean, I'd rather go for singles and doubles than get one home run and 9 strikeouts.
Yes.
Right.
Yes.
So what other challenges do you see facing the industry? It just seems to be fees are essentially getting erased completely. I mean, that's really been, again, another big part of your Twitter feed recently.
Oh, yeah. Fees are, look, listen, there is nothing more, I don't want to use the word sexy, but I will. There's nothing more sexy in the financial markets these days than a single-digit expense ratio. If you can get less than 10, 9, 8, 7, everybody will answer your call. It's the new 5-star, right? It is what people want. Something occurred around 2008. I just think people just thought, I'm not really going to get a lot out of my active anymore. A lot of advisors went from getting commissions to being fee-based. There are a lot of other things, but people just don't want to pay a lot for this muffler anymore, and it's showing up in the flows. And that, to me, is the mother of all trends, is high cost to low cost. Because even in smart beta, which is active-ish, and active, pure active, you see people going for cheaper stuff. It's not being abandoned completely, but they do want it cheap. And of course, when it comes to even just regular index funds or say like plain vanilla, I've seen money go from a 5 basis point ETF to a 4. Like they'll actually sell you out for 1 basis point. It's getting that intense when it comes to the fees. So fees are a huge deal. And one big worry, as you asked me, is just, over trading. Vanguard of all people just announced commission-free trading on all the ETFs. Fascinating development. But do you really need to be trading ETFs all day? If you trade a lot, in my opinion, you probably are going to ultimately lose money. And that would erase all of the benefits from the tax efficiency and the low cost the ETF gave you. So in my opinion, ETFs are really valuable, but in so much as you can control yourself.
Right. Well, that's a big issue for a lot of traders out there. But let's wrap up with what's your outlook on the industry? Do you continue to see the growth that it's a $5 trillion industry. That's pretty quick in 25 years.
Yeah. In the U.S. alone, it's $3.5 trillion. So I looked at flows. We just finished first half flows to second. What you're seeing is really interesting. A lot of the money is going into ultra short-term debt ETFs like cash because people are a little nervous, trade wars. And that's what makes ETFs interesting. They're not going to take in as many flows as last year. Last year, $486 billion. This year, they've had 128 through the first half, so clearly a lot less. But through the first half, the market's only up 3%. Last year was up 10% this time. So the market will definitely help or take away from ETF flows. But it's amazing they can take in that much with the market only up 3%, which leads me to my other point. A lot of people will think that the ETF is just the S&P 500, and it's like all people going into FANG stocks through the ETFs. People forget that ETFs have ultra short-term debt. They have the things where you go to hide out. They have the things that hold value stocks. So what I see coming in the next couple of years is money's going to start maybe not going so much blindly into S&P 500 ETFs, but maybe picking their battles a little more. Let me get some cash. Let me go into consumer staples. Let me use value. But again, those kind of plays, there's an ETF for that too. So the industry should grow regardless of the market environment, just maybe not as gangbusters as last year, which was really in large part because the market went up so much.
All right. Well, thank you very much for joining us at MarketSite. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.